Welcome back to Trader UK, the money management channel. Today, unfortunately, I'm back with what looks like a bad piece of news for investors, something that could see 20 or even 40% of accumulated gains wiped out overnight if you are not prepared. I'm going to be running through the BBC article that this came to light in, and we'll also look at how every investor should be preparing for this now. Before we get going today, as always, if you can hit the like button for me, and if you enjoy the video, don't forget to subscribe for more similar content. So here we have the article, a big picture of Rishi Sunak. If you don't know, this is the Chancellor of the Exchequer in the UK. Capital gains tax rate should double, says government review. Let's scroll down and take a little look at what it says in here. The amount of tax levied on capital gains could be raised by billions of pounds, according to a new report. About £14 billion could be raised by cutting exemptions and doubling rates, according to the review, which was commissioned by Chancellor Rishi Sunak. So what's actually interesting about this straight away is the fact that it was commissioned by the Chancellor. Quite often you get these reports from third parties, not actually commissioned by anyone, just throwing their opinion into the mix. But this one is obviously going to hold some weight. And it says the main losers would be wealthy people who own second homes or assets not shielded from tax. We'll take a look at assets that are shielded from tax in a second. It comes as Chancellor Rishi Sunak looks for ways to cover the enormous cost of the coronavirus pandemic. So although this is going to be very relevant for investors in the UK, it's probably going to be relevant elsewhere as well, as other governments around the world look for ways to cover the cost of the pandemic. After all, they've all had to prop up the economy in one way or another. In September, he reassured recently elected Tory MPs there would not be a horror show of tax rises with no end in sight. The Office for Tax Simplifications, OTS, however, found that many current features of the capital gains tax can distort behaviour as people try to lower their bills. The Office for Tax Simplification, their job is just that, simplifying tax in the UK. At the moment, it's far too complicated. You have different rates of tax and actually different taxes altogether for different sources of income. So their job is to bring things in line. In my opinion, 5, 10, 15 years down the line, there'll be one tax that'll be applied to all sources of income. You'll still get taxed at different rates depending on your income levels and your level of wealth, but it's going to be much simplified as opposed to how it is now. And where it says here, features of the capital gains tax can distort behaviour, this is going to be where people are selling up part of their portfolios or selling off certain assets that they own just before the end of the tax year, utilising their tax-free allowance and then rebuying them at the start of the new tax year. The government-run body says the tax, which is levied at 10% for basic rate taxpayers and 20% for higher rate taxpayers, could be doubled if it were brought in line with income tax. Capital gains tax is the levy you pay on the profits or the gain that you make when you sell, give away or dispose of something you own, such as shares or property. So yes, capital gains tax really at these rates, 10 and 20%, is considerably lower than income tax. If you think about it, in your employment, if you're a basic rate taxpayer, you're paying 20%. If you're paying higher rate tax, you're paying 40%. So it is double, and it would seem a little bit unfair given that. To highlight the problem that they're clearly having here, think of two different examples. The first person has one source of income, employment income, £40,000, let's say. That puts them firmly into the basic rate tax band. They have their personal allowance of £12,500, which is tax-free, and then the remaining £27,500 will be taxed at 20%. That's a tax bill spread across a year of £5,500. Compare that with somebody who has two sources of income, the first being employment income of say £12,500 and the remainder, £27,500, is made up from their investments, whether it's day trading or longer term investments. So they actually have the same amount of income, £40,000 per tax year. But for the second person, their employment income, again, they can utilise their personal allowance of £12,500, meaning they won't pay any tax on their employment income. Their investment income of £27,500, they actually have another allowance, their capital gains allowance of £12,300 to deduct from that, which leaves them with a gain of $15,200, but it's only going to be taxed at a rate of 10% because it falls under capital gains tax. So they're going to pay £1,520 of tax. Compare that to the £5,500 that our first example paid. Of course, this doesn't seem very fair, and you can see why they're trying to combat this. It then goes on to say the report also suggests the amount raised could also be boosted by cutting exemptions. This is the most interesting part here for me. At the moment, the first $12,300 of capital gains is exempt, which I just mentioned. About 50,000 taxpayers reported profits narrowly under the threshold last year. So at the moment, the capital gains exemption or allowance of £12,300 per tax year cannot be carried forward. So you can't roll it forward, make a big gain in a later year, and then use your unused allowances to write off that gain. But to get around it, what people are doing is at the end of a tax year, selling off some of their assets, utilising the allowance, and then repurchasing them at the start of the new tax year. So you're not really missing out on any of the work or the gain that the investment would have made you, but you are utilising as much of your allowance as possible. It also says, on Wednesday, the body said that the current rules were counterintuitive and created odd incentives. The disparity in rates between capital gains tax and income tax, which we've already looked at, can distort business and family decision making and creates an incentive for taxpayers to arrange their affairs in ways that effectively recharacterise income as capital gains. Now, this is actually something completely different to what we mentioned before. What we mentioned before is just clever tax planning that everyone has access to. But this that they're referring to here is something different. So I imagine what's happening is wealthy families that own big companies, and I mean unlisted companies, but big companies nonetheless, rather than taking a salary from their company and paying income tax at 20 or 40 or 45%, they'll be taking some kind of share incentive where they get shares in the company in place of their salary. When they then sell those shares, they get taxed under capital gains tax at a much lower rate as opposed to taking the income as a salary. So most likely that's what they're referring to here. Before dropping your jaw in horror that the Office of Tax Simplification is suggesting capital gains tax could be brought more in line with income tax or doubled, pause for a second. In most years, most of us won't pay it. In fact, even if the number of people paying it trebled, it probably still wouldn't be you. And that is true to some extent because most people don't invest. People don't invest in the stock market. They don't own second or third properties, but it's still going to have a big impact on those that do invest. More than 31 million people pay tax on their income. Their employment income usually, or self-employed income, raising 180 billion in 2017-18. By contrast, only 265,000 pay tax on capital gains, the profits they make when they sell assets such as shares or bonds. So there is a big difference there, and clearly post-pandemic, there's a lot more people investing and buying stocks and shares and property as well, whatever it might be, and putting their money to work now. So the government are probably getting a little bit concerned that they're not getting as much of a cut of that as they would like. It says the first 12,300 is exempt, we've already said that, and because you can control when you sell an asset and realise a gain, some 50,000 people can arrange their affairs so any gain they made comes just under the threshold. And when they do pay capital gains tax, it's at half the rate of income tax. The OTS report says most gains are concentrated among relatively few taxpayers who are paying proportionately less tax than everyone else. In other words, the light capital gains tax regime aggravates the already yawning inequality of wealth between the few who can actually make capital gains and the many who will rarely or never do so. So again, it's a good indication that they want to bring things in line, and probably they'll just get rid of capital gains tax and have one tax that covers employment income, dividend tax, capital gains, whatever it might be. It's going to be much more simplified when they do get round to actually implementing this. And it finishes up by saying, the independent tax advisor also suggested scrapping the rule which allows capital gains tax to be wiped on inherited assets. So that shouldn't affect too many of us. That falls under inheritance tax, as well as removing relief for investors selling shares in unlisted companies who have had them for a minimum of 3 years. So that actually brings us back to the point I made previously. Rich families that own big companies, unlisted companies, but big companies nonetheless, taking their income as shares or some kind of share remuneration scheme. If they hold those shares for 3 years, rather than paying capital gains tax at a reduced rate, they're actually going to be exempt from capital gains, and they'll pay absolutely nothing on their income, zero. So yeah, there's obviously a big problem here. If the recommendations are taken on by the government, thousands of taxpayers may face higher rates on the profits made on selling second homes or investments. Mr. Sunak commissioned the report in July, but does not have to accept its findings. A spokesperson for the Treasury said the government's priority right now is supporting jobs and the economy. We thank the OTS for their independent report, which will be considered in due course. So that's a little bit of a lifeline at the end there, basically saying that right now they need to focus on the economy and keeping people in work, but eventually, yes, most likely this will be considered, and I would say there's a 90% chance that this, or a lot of it, will actually be implemented. So yes, on the whole, it's not great news for investors, particularly rich investors. If you have a big portfolio, you could end up getting caught out by this. But I said we'll also look at how we should be preparing for this. So first of all, let's remember this isn't actually confirmed yet, but I think, like I said, probably a 90% chance that it will affect us in some way in the future, and it probably will be actioned in the next few years. That gives us a little bit of time to get our affairs in order. The first thing that I would recommend we all do in the UK as investors is utilise your capital gains allowance at the moment. Wherever possible, do what these 50,000 people, or rich investors anyway, in the UK are already doing. It's just clever tax planning. All you need to do is calculate the gains that you've made on your individual investments and then sell as many as possible to get you as close to that £12,300 tax-free limit. If you have less than £12,300 in gains, that's great. Then you can sell off pretty much your entire portfolio, realise the gain, take it tax-free, and then you can just repurchase it. For example, I have a portfolio that is about £5,000 in the green at the moment. So before we get to the 5th of April, what do you think I'm going to do? I'll be selling off all the positions that are in profit, not the ones that are loss-making. I'll keep those and roll them forward so I can utilise them against future gains. I'm going to declare the sale on my tax return, or there's a government gateway login that you can use just on their website if you're not registered for self-assessment. And I'm not going to be charged any tax, but essentially what you're doing, you're resetting the clock. You're locking in those gains whilst they're tax-free, rather than carrying them forward to a future year where your tax-free allowance could be pulled away from underneath you. And there's nothing stopping you from reinvesting. So if on the 5th of April I sell off my entire portfolio, realise the gain tax-free, it's then a new tax year on the 6th of April, so I can repurchase everything anyway and continue, wipe the slate clean and move forward with my investments. The second thing I would recommend that everybody is doing is holding or moving as much of your portfolio into an ISA. So this is what they're talking about at the start of the article when they mentioned shielded from tax. That's exactly what an ISA will do for you. Now, I will do a separate video to explain how ISAs work and how you can best utilize your ISA allowance, but just know that from my experience, Trading 212 allows you to hold investments in an ISA, and they do that free of charge. I know some of the other apps, Free Trade I was using for a while, they actually charge you for that feature. But yes, Trading 212, it's free to invest via an ISA. So again, before the 5th of April 2021, utilize as much of your ISA allowance as possible. You can see on screen, you can currently invest up to £20,000 per year into an ISA. And once you're done, any capital gains, any dividend income from that investment is all tax-free. It's outside the scope of what we've been talking about before. So utilize that as much as you can. So even if you have to sell off some of your portfolio and repurchase it under the protection of an ISA, then it's certainly something that investors should be doing now, or certainly in this tax year. Just be careful when you're selling off your positions that you don't realize too much of a gain. Like we mentioned in the first point, it's when you sell your shares that the capital gain is realized. Even if you reinvest it the next day, you've already realized that gain. And finally, I recommend that everybody stays up to date with these announcements. Watch out for the budgets. That's going to keep you really up to date. Watch out for anything that Rishi Sunak, the Chancellor, says, as if you're investing, some of it is going to apply to you. And if you know in advance, you can plan for these things. No matter how bad they are, you can plan for them, and most of the time you can actually avoid them, providing you're planning in advance. The autumn budget was actually cancelled due to the pandemic, so we'll have to wait until most likely March, or they could make an announcement in between. But whenever it's made, make sure that you watch out for the changes that impact you as an investor. If you know about the changes in advance, we can plan for them. Unfortunately, it's usually the people who don't stay up to date that end up getting caught out by these changes. So that is everything for today, guys. Let me know down in the comments if you have any questions. Let me know what you think about these changes, if you're likely to get caught by them, if you already hold your stocks in an ISA, and what changes you will make in light of this. Thank you for watching, and I'll see you next time.